Hello, I'm Beau Henderson, and welcome back to Rich Retirement TV. And I want to start off today and ask a question. Is your 401k a tax trap? Doesn't sound too good. Now, you've heard on other episodes, we've talked about the 401k being a great vehicle for saving assets, for accumulating assets during your accumulation years or your working years. And that's true. But a 401k can also be one of the worst vehicles for distributing assets in retirement, and there's a few problems that come up. One is every distribution that you take from a 401k is going to be taxed at the highest possible tax rate possible. And what I mean by that is it's going to be taxed at your tax rate that year. It's going to be much higher than capital gains tax rates or tax-free situations from other types of accounts. So it's the highest way we could be taxed to distribute money out of the 401k. Another is you kind of get a double whammy with double tax. Money coming out of a 401k counts towards your provisional income formula, and your provisional income is what determines how much of your Social Security benefit is taxable. So imagine that, right? That's no fun. We're going to pay tax the highest way we can. We're going to pay tax taking money out of our 401k, and then it could be increasing the tax we pay on our Social Security benefit. A double tax whammy there, right? A third thing we need to know about our 401k and why it might be a tax trap and might not be the best vehicle for retirement is required minimum distributions. And as we go into Secure Act rules, everybody's going to be required to take required minimum distributions by age 72 now. Now the issue, if we don't take that money out, there's a nice little 50% penalty there, or tax that we're going to have to pay on RMDs. And the 401k money is subject to required minimum distributions, whether we need that money or not. Whether the market's up or down, we are forced to take that money as a required minimum distribution. In fact, recently I sat down with a client, and his whole issue was he had an IRA of money that he didn't need, and it came from a 401k that his primary goal was to leave this money to his kids. But the problem he was having, his required minimum distribution was forcing him to take over $100,000 a year of required distributions that he didn't need nor did he want, and he was being taxed at the highest rate possible on that money. So that was his issue. So RMDs can present a problem if we get to retirement with giant 401ks, and that's what we roll into throughout our retirement years. The other thing I really think is important and relevant to talk about when we talk about why 401ks could be an issue is it's the absolute worst vehicle from a tax perspective to leave to your surviving spouse. So think about that. You leave money to a spouse with the best of intentions, and what you might not really realize is that you have a partner in that, right? Your spouse is going to have to split that money with a guy named Sam, Uncle Sam, right? Probably not your biological uncle either. That's tax money that's going out. So we're leaving money to our spouse in the highest tax way possible. So there's all these traps that can come up in our 401k plan as we're navigating retirement. So what can we do about it? There's a couple things you can really look to address, and it all comes with your strategy and how your plan lays out over the timeline of your retirement. There's some things you can do with life insurance. We could purchase life insurance with distributions early on that have a little leverage and tax-free death benefit to beneficiaries. That can address some of those problems, but one of the more popular strategies that's really been effective that is actually looking at Roth conversions, and that's converting some of those 401k assets in an amount that makes sense year by year. And how you do that is we're looking at a tax return and we're seeing how much room do we have before we bump into the next tax bracket, and that might give us the available amount that we want to consider converting to a Roth IRA. And why convert to a Roth IRA? It really addresses all those concerns we have. The Roth IRA doesn't count towards provisional income, thereby not impacting your Social Security tax at all, or how much your Social Security is taxed. It'll pass to your beneficiaries tax-free. It's not going to be subject to RMDs. So that conversion to Roth IRA, and a lot of the best ways to do that is whether you've started retirement or you're working up to retirement, say a 10-year window to retirement, is to start looking for opportunities to convert that money. And if we can convert as much of that into that Roth IRA bucket by the time you reach age 72, and RMDs are required, maybe we've really done a lot of work to minimize those RMDs and offset a lot of those other tax traps that show up. And unfortunately for a lot of people, it unknowingly shows up until it's a problem with the 401ks. And that's what I'm really about here, and that's what I want to encourage is let's proactively address this. Let's look out in the future and say, what will happen in the future? What's our plan for that? And let's proactively build a strategy that's going to put you in the best position possible and keep you from being a victim of these traps. So I hope that was some helpful tips. If you have other questions about 401ks, the rules, the traps, and how to navigate it, Roth conversions, let me know those specific questions and we'll address them right here on Rich Retirement TV. Other tips, and below in the comments you'll see the Rich Retirement cheat sheet, other tips to successfully navigate retirement. And as always, subscribe to this channel and let me know what other things you need, whether it's financial, whether it's lifestyle, whether it's health, whether it's relationships and retirement. What are the things that would be of value to you to know about navigating that successful retirement? And until next time, I'm Beau Henderson, and I'll see you right here on Rich Retirement TV.